Well, welcome back to Finance Uncut. On today's episode, Basel III equals $855 silver. Basel III. In this video, I'm going to give a simple explanation what Basel III is, why we're having Basel III, where it came from, what it all means for gold and silver investors. And towards the end of the video, I've got some good news and I've got some bad news. So stay tuned to the end. So Basel III was designed to avoid a mismatch between the bank's assets and liabilities, like what happened in the GFC when we had some banks failing. And they were failing because they were financing their operations through short-term liabilities for mortgage products. We saw Northern Rock and Lehman Brothers go under, but also in Australia, if you remember, Rams Home Loans, so they went under, so they were using short-term liabilities to finance their long-term assets, so their mortgage products. And Westpac bought their loan book. So if you've got a Rams Home Loan today, it's now owned by Westpac. We also saw companies such as Babcock and Brown and ABC Learning. They were also financing their operations using short-term liabilities. And then when we started to see a run on some banks, lack of liquidity in the lending markets tightened and funding dried up, which meant that these banks, and in the case of Babcock and Brown and ABC Learning, they went under. So Basel III is supposed to protect from future interbank counterparty risk. However, I think there's more to it than just that. And don't forget, we've got Basel IV, which is supposed to come out in 2023. And I've had a brief look at what that's supposed to all mean, and that's quite scary. And so in this video, I'm just going to try to explain as I piece the dots together and where I think this is all headed and what it all means. So in my opinion, Basel III is a form of monetary reset. A lot of global debt needs to be offloaded to global bodies such as the World Bank and IMF. Gold has been given an 85% net stable funding ratio. So what this means is it will increase the cost of funding to banks, for banks to hold gold on its balance sheet through increasing their shareholder equity. So this is going to increase the financing activities for the LBMA bullion banks. Now, the LBMA released a letter entitled Impact of the NSFR on the Precious Metals Market. And they are screaming blue murder. And so anything that, if the LBMA and the bullion banks don't like this, then that's a good thing for us gold and silver investors. In fact, the letter here, I'll put a link in the description below so you can read it. It's about 54 pages. And they've since released another piece, I think just a week or two ago, which you can Google and find. So what were the key things in that letter? So the key things were they claimed that it would undermine clearing and settlement, that it would drain liquidity, dramatically increase financing costs, which I explained before, and curtail central bank operations. Don't forget the LBMA trades $20 billion a day or $5 trillion a year, with almost all of it being done in unallocated positions. So this is predominantly a paper market here. And I'm sure I don't need to explain to you guys that it is done to manipulate the price of precious metals. So this means the impact of Basel III on this $5 trillion a year, predominantly unallocated trading, will dwindle the overall paper supply of gold, which surely is bullish for the precious metal. So why introduce these requirements which will impact the manipulation of these precious metals markets? Why we've had central banks and governments wanting to suppress the price of precious metals to hide inflation and their debasement of the currencies and whatnot. So why introduce these requirements which will impact the manipulation of these metals? Which obviously, if there's less paper supply of gold and silver, then we're going to get more of a free market price, right? So why do that now? And that's where I've been exploring to try to answer this question. So it's obviously starting in Europe. And if you have a look at the Euro banks, and look, a lot of us are surprised that the Deutsche Bank is still standing upright at this point. Many people have been shorting Deutsche Bank, thinking that it's going to go under. It's very unhealthy, but the whole Euro banking system is extremely unhealthy, and since the GFC, it's never recovered. So Basel III is starting in Europe, and then it's moving to England then. So central banks have been cleaning up a lot of toxic debt since the GFC, and have since provided further support to governments, commercial banks, financial institutions, and corporations now as well. And you can see the central bank balance sheet here, and you can see that the ECB, who would have thought that they would have overtaken the Bank of Japan in what they're doing? And so, so we've got this issue with central banks. They've been taking all this toxic debt since the GFC, as well as providing even more support now. So we are in a world that is just got a glut of debt, whether it's from household, corporate, or government debt. And so there's a big issue with this debt. So Basel III is, as I said, starting in Europe with English banks beginning in January 1, 2022. The assets held by central banks have deteriorated in quality and value. So there is some talk that if the ECB went bankrupt, this would cause huge ramifications for the World Economic Forum, Bank for International Settlements, the International Monetary Fund, and other institutions plan for a reset in negotiations with countries suffering sovereign debt problems. So if we have a look at the balance sheet of the ECB, they currently hold about 504 tons of gold at a value of $30.7 billion. The IMF currently holds approximately 2,814 tons of gold at $171.9 billion. And the Eurozone currently holds approximately 10,000 tons of gold at $611 billion. In fact, I think that's now pushing towards 11,000 tons of gold across the Eurozone. So when we have a look at gold reserves, apparently the US still has the most gold reserves, followed by Germany, Italy, France. But what's interesting is you have a look at Russia and China there. Russia, over the last 20 years, have increased their gold reserves by 443%, and China 393%. And then India, just down there with 677 tons, they've increased theirs by 89%. And when we have a look at the gold as a percentage of these reserves, you can see Portugal take the top mark there with 81.6%. The US 78.6%. But Russia and China, so Russia 23.3%, China only 3.5%, but we don't really know how much gold China really have, do we? Russia 23.3%. What's interesting there is Russia have now, even though it's 23.3%, that is more as a percentage of their reserves than what they're holding in US Treasury. So that's just been a recent development. So back to the balance sheet here. So the ECB balance sheet has about 7 trillion euro or $8.5 trillion worth of debt. And so we've got this mismatch that we saw during the GFC when these banks failed. So central banks will need a higher gold price to improve their balance sheet. So I did this video, gold 50,000 and silver, with Luke Groman. Luke has been arguing that the same thing, central banks need a higher gold price And the way Luke thinks that this comes about is quite striking. And so I'll put a link in the description below. If you haven't yet watched this video, it's definitely worthwhile. And it's not just Luke Gromen saying that. Jan, and it's not just Luke Gromen saying that central banks need a higher gold price. Jan Nieuwenhuis says the same thing. Gold is the only way out for central banks. Central banks want inflation. They need a higher gold price. Central banks want to repair their balance sheet. They need a higher gold price. Central banks want to reset the system with an immutable, neutral, and evenly distributed reserve asset. That's gold. So what will Basel III do? It will help fight back against the crypto market. All you have to do is just listen to what the ECB, the IMF, the World Bank, the Fed, the Bank of England, all of those bodies are saying about private decentralized crypto markets. They do not like it, and they are going to fight it. It will allow for a quiet reset compared to the hard reset undertaken by Roosevelt when he signed the Gold Reserve Act on the 30th of January in 1934. So instead of stealing and making it illegal for people to own gold, I think this is a way that they will do it. They've been buying gold like no tomorrow, and I think this is how they're going to do it. This will also help central banks avoid the need to revert to a gold standard and help ensure that the ECB and other central banks can implement their central bank digital currencies. So central banks and governments do not like the gold standard because it puts restrictions on them. As much as I might want that, I don't see that happening. I think that Basel III will help them revalue gold to help their debt problems. It'll help them to avoid the need to revert to a gold standard. Perhaps in time they'll have no choice, but it will also help to ensure that the central banks will be able to implement their central bank digital currencies, which are coming. So this explains the increase in central bank gold purchases since the collapse of the banks during the GFC, including the Bank of International Settlements, who have loaded up with 1 million ounces of gold. And just this year, central banks have been buying gold like no tomorrow. And Wall Street for Main Street's Jason Burak has reported from the World Gold Council that central banks in 2021 have bought 164 tons of gold. So what does this mean for the gold and silver price? Where is gold and silver heading? Well, before we come to that, let's cut to a clip and have a look at what Chris Marcus has to say about that.
So I was trying to make sense of this, and I went and make the same way you're going to see the gold to silver ratio. I went and did the GDP to silver ratio, the total market cap to silver ratio, the Fed's balance sheet to the silver ratio, oil, copper, the average house, and then also crypto, just to have fun. And so I went.
Can we start with the Fed's balance sheet just for my own amusement? I'm so giddy. I can't even wait to see what that number looks like.
Sure, yeah. Those are always the funniest numbers. But so I went as far back as I could, the easiest way that I could find. And I took like important years. So 1980, we had hyperinflation. I mean, not hyperinflation, but inflation over 10%, I believe. And then the rest, you know, right? Stock market top, bottom, and then a top, a bottom, then a commodity top and a commodity bottom. And I went, and then 2020, the bottom as well. And I made all these ratios. And I said, what if so I have a price target following the ratio. And I say, what if we go back to that ratio, to the best ratio that we've ever seen? Where should the silver price be right now? And so you said relative to the Fed's balance sheet, that's always the largest number. So relative to the Fed's balance sheet, if we ever go back to the ratio, the best, quote unquote, best ratio that we've ever had relative to Fed's balance sheet, silver should be at around $855 right now. That's what it says on here. The same goes for the total market cap. Actually, I got surprised. The stock market has outgrown silver by so much that if we ever go back to the best ratio that we ever saw, I'm not saying we should or we would or that or it's probable or whatever, but if we would, silver would be at around $500. And so I've done that for the ratio. Taking the best ratio that we've ever seen, which is to say that the lowest ratio on here. And I've also done it for the all-time high. So when silver hit an all-time high, which was almost $50. And I've also looked at what was the ratio at that point when silver hit that all-time high. And if we ever go back to that ratio, then we start working with some of these numbers on here. Again, if you compare it to the Fed's balance sheet, it should be at around $134. If you compare it to the market cap, 151, to oil, even 154. And so when I look at these, prices on here, these price targets, they don't make any sense to me. I mean, I don't see anything near $30 on here. That we've seen in the past. So I don't understand how can silver be $28 right now? How does that make sense?
Because they sell paper gold and silver. They sell the same ounce of silver, God only knows how many times. You have the CFTC and a market structure voted on by criminal banks that tamps down the price. You have a commissioner that acknowledges the silver price was controlled as well as the volatility. That's how you keep the price of silver. And I might add that anyone I've ever met that actually really understands what the Fed does and doesn't just read what the crap they put on CNBC and take that as gospel, which is a very unfortunate thing that happens. People that really dig into the Fed and understand, they buy gold, but those are the ones that buy silver the most. So, I know Bitcoin's popular now and that's fine, but the people that really are studying the Fed and the monetary supply, in my experience, those are the ones that really go to silver. Now, that's a small subset because a lot of people are being lied to and are not aware of what's going on. But look at what happened in the beginning of February. Silver broke over $30 for a couple of hours. That's only the third time that's happened in history. Realize that? 1980, 2011, it was up for a little while before it came down. But this is the only third time it popped over 30. And all of a sudden you see CNBC has bullion dealers on TV. Wall Street Journal is writing articles about silver manipulation. And I don't think it was an accident they finally sent out Jeff Curry, who had never commented on silver before, at least anywhere that I can find. And he came and committed a series of felonies that week, February 2nd, February 4th. Probably would have done it February 3rd, but that was the night that his bank was busy changing the prospectuses to protect them, legally protect them, give them a weasel clause, protecting them against a silver short squeeze. While Jeff Curry went and lied on TV, both times saying it's impossible to have a short squeeze because of position limits, which his bank, Goldman Sachs, routinely violates. And when I called the CME to ask about that, they said the CFTC is the one who's keeping an eye on it. Okay.
All right, so here I'm getting to the good and bad news. So gold investors are likely to see a gradual phase of market prices for gold, which will delight the Russians, Chinese, and Indians, as well as, us investors. While Klaus and his mates at the WEF, IMF, BIS, and all the other globalists will accept this as a necessary prerequisite to ensure that the ECB not only survives, but that the digital euro, followed by other central bank digital currencies, are rolled out, which will help them implement their technocratic Great Reset program, which they've longed for. And so this is the bad news. And if you don't believe me, check out this article. Mark Carney, the former head of the Bank of England and the Canadian Central Bank, he even admits that it won't be pleasant. This new dystopia, this new technocratic Great Reset that he is now pushing like no tomorrow, along with his mate Klaus, in the name of climate alarmism. Am I allowed to say that? The tube's going to get me for that word. Anyway, who cares? I'll put a link in the description to this article. Read it. You can see it's dated 12th of June. So, this this is like a couple of days ago. So, that whole Great Reset, if you're unsure about, what that means, it just means, and Mark even says in this piece that he admits that we're going to have to give up freedoms. And so this is going to be good for gold investors because of the reset, in price. But they are doing it not to benefit gold and silver investors, not to benefit the retail precious metals investors. This is all about them getting their own way, creating their own dystopia, which I think is quite unpleasant. However, on the good news, in this article from Sprott Money, anything and any regulation that restricts or removes the bullion banks' monopolistic influence on the current pricing scheme should be considered a major improvement and a cause for hope in our fight for a free and fair system of true price discovery, just as Chris Marcus was saying before. So, in my opinion, we will see a rise in the gold price and therefore the silver price, perhaps with a jump as early as July, as there's a scramble for physical metals as these banks try to cover their short positions. And I think I've seen some data over the last 3 months that they've been doing that anyway, that they've been reducing their short positions over the last 3 months. So they're obviously preparing for this, as the paper contracts unwind. But I think it's more likely that we'll see a gradual but steady increase over the next 2 to 3 years, because I think that they need the gold price to be at least $10,000. Perhaps more, perhaps a little bit less. I based on the study that I've done, they need at least $10,000 in the gold price to be able to do that. And so with that, silver, whether you just want to use the current gold silver ratio, what is about 65 at the moment, even if you wanted to use that at 10,000, that's a much higher price for silver. Look, even if you think that this is just the inflationists talking, look, Jim Rickards is out there and he's been preaching deflation for the last 12 months. But even he says, and he's the author of the new case for gold, even he says that central banks and governments need to reprice gold to get out of the mess that we're in. So, do I think silver's going to be $855? What do I think? I think within the next 2 to 3 years, gold will be somewhere around that 10,000. And so I expect silver, even based on current gold silver ratios, to be somewhere between $100 and $200 an ounce. Perhaps, as we see the manipulation come off, that gold silver ratio moves back to something more likely, more like the actual mining numbers. So, Keith Neumeyer from First Majestic says that it's 7-1. That's the mining ratio. Or whether we get back to Newton's, 16-1, Adam Smith's 15-1, then silver could very well be $300, $400, $500, $600 an ounce. If we do see the currency fail, then we're talking silver in the thousands of dollars an ounce if the currency fails. But a lot of people can't get their heads around these numbers because I think a lot of people have been experienced the manipulation in the metals market and have been frustrated for quite some time. But as says here with Sprott Money, anything that improves the current pricing scheme and removes that the bullion bank's ability to manipulate the price, then we're going to see more of a free and fair market, true price discovery. And so where that ultimately lands, I'm not sure, but I do know it's much, much higher. You know, I've done videos about wealth cycles, how I'm, you know, move from one asset class to the next. I won't be moving out of my silver anytime until it goes post triple digits, because I believe that's where it's headed. So I will not be moving out of the silver market into other assets until that occurs. So, but that's my opinion. What do you guys think? Love to see your thoughts and comments below. Don't forget to hit that like button if you like this video. Please hit that like button. Give me that thumbs up. If you haven't yet subscribed, do so. Hit that notification bell. Take care, everyone, and I'll see you again on another episode of Finance Uncut.